Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money. Here is your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think a 20% number on everything that's imported into this country is a massive number. And it's part of the president's larger plan. And we also don't know what the retaliations are going to be. So it's really hard to game plan how this is going to play out for earnings, how it's going to play out for the economy. It means there's still a lot of risk out there that's yet to be, priced into share prices.
I think what we saw with the Ford numbers, and we'll see with other numbers as they roll out later today for March in the first quarter, is that the consumer is a bit freaked out. They're acting somewhat logically and going in and trying to buy the vehicles they may need in the coming months or maybe coming years ahead of these very significant hikes in prices as a result of tariffs. And sort of simply as we think about this, the vehicles that are being imported, the pricing could rise as much as $10,000 to offset the tariffs.
Well, I think the net of all the data released in the JOLTS report implies to us that we're going to get a healthy gain in payroll employment. It's not going to be substantially stronger or substantially weaker than the last number. There'll be rounding error differences between what happened in the month of February and what happened in the month of March. It tells us that basically the labor market remains firm.
All right, we've got 1 hour to go until the market close. And right now, I am joined by Al Root. He is Barron's associate editor who will be hanging with me for today's show. Al, great to see you. Thanks for joining us.
Thanks for having me.
All right, let's start off these markets, Al, get your take here, because I'm looking at the popular averages. Got another volatile day here. We did get some weak manufacturing and jobs data, so I'm looking at the Dow. We're down about 200 points. Your broad gauge, the S&P 500 is down about 0.2%. NASDAQ is up about 0.2%. The word of the day, though, Al, as it has been, is uncertainty, because, of course, tomorrow it's Liberation Day, Trump's tariff plan. I don't know what's coming. You don't know what's coming. The market doesn't know what's coming, which is partly explains why we've been shaky here.
Yeah, I think you summed it up. I mean, if you look at today's trading, right, we're into the red, we're into the green, we're into the red. And it's like the tremor before 4:30 in the Rose Garden, right? We're all just waiting to see what happens. But I think, we're down from February highs. People are cutting estimates for the S&P 500.
Yep.
We don't really know how bad it's going to be, so it's just like a waiting game. It's, a calm before the storm, a little bit of tremor before the storm.
To your point, you make a good one. I mean, we don't have, I don't know levels, I don't know specifics, details of these tariffs, I don't know duration. And importantly, I don't even know how trading partners, how they would respond. You would expect them to respond or retaliate. I don't know what that looks like either. The other interesting thing I'm going to be curious about, whether Trump kind of brings down the hammer, Al, but then tomorrow does he also, I don't know, does he somehow suggest that, you know what, I'm open for a deal? Say the right thing, we could work this out.
You laid out all the questions, right?
Right.
And market, more than anything, hates uncertainty. So you laid out like 4 or 5 things we cannot answer.
Yep.
And then if you just think about the cars, Canada and Mexico is supposed to be a national security issue with fentanyl.
Yep.
It's not a national security issue. Forget it. 25% on everything imported from all around the world.
Yep.
So I think, from the people we chat with, nobody really believes that the hammer will stay. So there might be a big splashy announcement, but there'll be room for negotiation. I think that actually is a risk, because President Trump might be a little more serious about this than anybody gives him credit for.
Right, we're going to find out soon enough, Al. All right, that was markets. Let's talk about your bread and butter, all right? Let's talk about what Al does. The autos. Tesla showing its sales are continuing to slide in Europe. Registration data in key European regions fell in March. And for the first quarter, the EV maker seeing declines in sales from France, Sweden, Norway, Denmark, and the Netherlands. As for the United States, though, Ford reporting a decline in U.S. vehicle sales, even with continued growth with its F-Series truck. Meanwhile, GM reporting double-digit increase across all 4 of its brands. However, this all comes, of course, ahead of the looming auto tariffs expected to take effect this week on April 3rd. Let's start with Ford and GM, Al. Just get your take. What do you make of those numbers? What do you make of what they said? And also, what do you make of sort of the investor reaction?
Ford numbers were good.
Yeah.
General Motors numbers were good. A couple of things. Remember, these are wholesale. So, Ford truck sales jumped 25%, but that's to the dealers. Retail sales were up about 5%. Again, a very good result for Ford. General Motors, you saw 17. That's a very good result. If you look at the reactions, it doesn't matter. Because this is the first quarter, there's no tariffs. Some of that could be, pre-buying from the dealers, trying to get ahead of any price increases. And with
it doesn't matter. I mean, you mean it doesn't matter because investors are looking through that.
No.
They're looking, right.
So if you look since the election, Ford is down about 5% coming into today. General Motors is down about 12%. Tariffs dominate. Nobody's cut their earnings estimates on Wall Street. They're just sort of waiting for guidance from the companies when they report first quarter results in a couple of weeks. So, these are nice results and it's good to see demand in Q1. But like to your earlier point, demand in Q1, what does it mean when prices go up, when tariffs start to impact? What do dealers do? What do incentives look like? So nobody knows. So it's like, hey, way to go, guys. You sold a lot of cars, but now we have to wait to see what the rest of the year looks like.
Can I dig into Ford for 1 second? We were talking off camera about this. The F Series. What was it up like almost 25%?
24.5 or 25.
What was that, Al?
So again, wholesale versus retail.
Yeah.
So normal.
Is that just Americans love their trucks though? Is that what I'm seeing?
Oh, so F Series still best-selling truck in America for 40 plus years. It actually lost its best-selling car title to the RAV4 last year. But that's okay.
Yeah.
We'll try and get it back. So, 15% of all the cars sold in America are sort of heavy-duty trucks.
Yeah.
Right. So Americans do love trucks, and this is what they're good at. This is what they make a lot of money on. So those cars are made in America, but still about 50%.
F-Series made in the U.S.
Yeah, but still 50% of the parts come from Canada, Mexico, and overseas.
Right.
So they still see an impact. It's the quarter-to-quarter fluctuations are about dealer inventories, what dealers think about tariffs and trying to get ahead of any price increases. So Americans love trucks. Excellent result for Ford. Excellent result for Q1 earnings. But these things will just sort of normalize.
Who's more exposed to these auto tariffs, Ford or GM?
GM.
Yeah.
So Tesla, 100% of the cars it sells in the U.S. are made in the U.S.
Yep.
Way to go. 80% Ford, 55% General Motors, a lot from Canada and Mexico. And then it sort of goes down from there in terms of the impact. So Ford is actually in a relatively good position. You see it in the stock price a little bit, but it's down less. So the mood is still terrible. It's just slightly less terrible at Ford.
Do you think, so you're an auto CEO, okay, my costs
I wish.
Yeah, right. Don't we all
Yeah.
now? But in this instance, here's my question. You think, okay, my costs are going up. Do I think, all right, I'm gonna eat the margin at least for a little bit as long as I can, or no, I pass it on to Al and Josh? Or do I think, I've been looking at these consumer sentiment surveys, Al and Josh don't seem very happy right now. I don't know if I can pass that along.
All excellent questions. Yeah. So you do a few things. One is the suppliers will try to jam the price increases down your throat, and you'll say, forget it.
Right.
So some of it will be borne by the suppliers. You won't call it a price increase, but the $1,000 cash back, the 0% APR for 36 months on qualifying lease, gone. So that's gone.
Adios, yeah.
That's worth $3,000 to $4,000 a car right now. So incentives go, and then you get down to brass MSRP sticker price. Right now, the average transaction price for a car in the U.S. is about $48,000. It's a lot. We heard John Murphy, $10,000. That's on the imports. About half the cars are imported. So maybe on average you creep up to $50,000. Suppliers bear some of it. You bear some of it on your margin. You reduce incentives, but you're still going to see some price increases. And the bottom line is sort of everybody's miserable. You're miserable because you just paid $3,000 more for the car, no subsidized rate. I'm making less money selling the truck. My suppliers are unhappy with me, and this is the reality.
Okay, so near-term pain. But let me ask you this, because as a guy who covers this sector, why is Trump doing this? Trump is doing this because he wants to see, I want to encourage more domestic manufacturing, and that is for sure long-term goal. But do you think at the end of the day that long-term goal is achieved? Do you think a lot of auto CEOs say, okay, whatever I was going to invest in the U.S., I'm going to increase it because I can't lose the U.S. It's too big, it's too important, it's too lucrative.
Yeah, the reality is the things happen so slowly. So you're an auto CEO.
Yeah.
Don't we wish? They get paid better than us. And you say, okay, I'm going to build a plant in pick state A, B, or C. I mean, that decision is literally a sort of a 5-year capital allocation decision.
A lot of time and a lot of money.
So NAFTA came in early 90s. At the time, we imported about 30% of the cars that are sold to Americans. 30 years on, we import 50%. It was a 20 percentage point move over 30 years. That's sort of the waves that you're dealing with. So they really are between a rock and a hard place. I think without question, people should not underestimate how much President Trump wants to make more things here. So that is the agenda, and tariffs are his primary tool. And what it means is pain in the interim, but the interim is probably measured in decades. Of course, we'll rebase and profitability will rebase, and we'll drive on after stocks adjust. But it's not an easy process.
Yeah. I mean, if you were an auto CEO, would you also be thinking, all right, if moving this production is going to be multi-year, multi-billion, is the other wrinkle, Al, you would be thinking about, well, this is definitely a priority for Trump, but I don't know what's going to happen in 28. I mean, who knows? Democrats, I got Shapiro or Westmore, maybe they move into the White House. In other words, I could have somebody in the White House who this isn't a priority for them, at least in the same way as it for Trump.
That's another $1 million question, which is one of the reasons that Ford, GM, and Stellantis, old Chrysler, trade for 5 times earnings. They're not exactly hot stocks, but no, you've made, and then your capital allocation decision outstrips this administration. So you really have to believe. Listen, I do think that it makes some sense to make more things here, right? And then we can talk about regionalized supply chains and how do we feel about Canada and Mexico. But it's really tough to a Mexican production worker working in a plant in northern Mexico, $3 an hour. A reasonably tenured UAW worker, we're talking $30 an hour. It's tough to overcome that. Yeah. So even some of the automaker decisions will be, I'm going to work like heck to get my costs down, but I'm not going to change my footprint. Others will build plants, and then we have to see how it goes. All
right, we shall see. Now, stick right there, because we're going to do another check here in the markets quickly here. Let's get an update on what the popular average is doing here. Dow still down 185 here. I'm looking at the broad gauge, the S&P. We're down about 0.2%. The NASDAQ up nearly 0.2% right now. We'll keep checking. We are just getting started here on Market Domination. Coming up, investors cautiously count down to President Trump's highly anticipated Liberation Day. Going to speak with a strategist right on the other side who recently lowered his S&P year-end target amid the current headwinds. Plus, what's next for Intel? New CEO Lipton making his first public appearance at the Intel Vision Conference on Monday. We're going to check in with an analyst later in the hour to discuss the future of that chip giant. Stick around, much more Market Domination still to come. Stocks mixed as investors cautiously count down to President Trump's highly anticipated Liberation Day rollout of sweeping new reciprocal tariffs. For more on what's coming next and what it does mean for the markets, let's now welcome in Venu Krishna, Barclays head of U.S. Equity Strategy. Venu, it's always great to see you here on set.
Thank you.
Let's start there. Let's start with Liberation Day. We've all been waiting for it. Or the expectation, Venu, is Trump's going to come out and announce this slate of reciprocal tariffs. Do you think, I'm just curious how you think about that as a strategist, do you think tomorrow will it mark the end, Venu, of all this tariff uncertainty? Is that it? We're going to hear it, the announcement, then we can all move on?
Absolutely not. But I would say that a subsection of investors I talked to do think that somehow April 2nd is a clearing event, and then life will settle. Our view is that that's just a starting point. So
and why do you think that, Venu?
Because it takes a long time to reciprocate and to haggle and to settle on the ultimate terms. And if it especially starts going on a bilateral basis, then you're doing against each bloc or a country at a time, right? And so this time, it appears that they are going to focus most likely on countries with the biggest trade surpluses versus the US, and ones which also have meaningful amount of tariffs on their side, right? And so to some extent, they will try and negotiate to level the playing field. To ultimately, the goal is to have more US access to those markets, for example, right? And the secondary objective looks like also is they want to somehow see this as a source of revenue to ultimately reduce your deficits, even though I'm not too sure how they can manage, given the scale of a deficit, which is running 6.5 to 7% of GDP. So I think this is going to be real. It's not going to be settled right away. And it probably takes at least 3 to 6 months. And that's on the optimistic side. And that's my base case. But things can go wrong.
Now, you said this is a starting point. Your job is to provide us all with security of forecast. Like, how do you deal with this uncertainty when you're thinking about S&P 500 targets, when you're thinking about the stock market, when you're thinking about impact on earnings? Like, I want to know, and I just can't know.
It's a great question. It's a very complicated question. But we've spent a lot of time and effort on trying to create a framework for that. So I would explain that in a two-step process. First is, till now, what we were doing is estimating the direct impact on earnings from tariffs. And that in itself is complicated, and you have to make a few assumptions because no company reports its imports or exports. So, we used macroeconomic data and somehow from there mapped it to the S&P and sectors, and then found a decent framework with the core assumption to estimate that impact. That's only one part of it. But remember, earlier, before I cut my price target in earnings, we were not incorporating that into our base case. It was there in my bear case, but not in my base case. Because the view was they will figure out some way to negotiate this and not let it escalate. But clearly, we are not in that zone. But what is even more important, and we said that even then, but now we're explicitly capturing it, is the second order effect, what I mean by that is, for example, our economists think that given a core level of tariffs, inflation is going to go up and your economic growth is going to slow down. And this is, even before this has happened, we were expecting growth to moderate because of immigration changes. So without even Trump going towards more hardline immigration strategies, in the Biden administration, middle of last year, you already have that stay in Mexico in case. So we were having almost 2.5 million immigrants net coming to the US. That was expected to go down to less than 500,000. So that supply shock in itself was likely to bring down and moderate growth. But now with the tariff rhetoric also escalating, we are forced to consider that. So now to answer your question, we look at the first order direct earnings impact, and then we also estimate the second order impact, which means that we now assume that consumption reduces, especially on goods. We assume that US economic growth moderates, especially industrial production. We assume non-US growth declines, and we assume that inflation also picks up. Once you start putting in all these factors to give you a sense of scale, earlier before I cut my numbers, we were expecting S&P earnings to increase 12.5%. An acceleration from last year's roughly 9-10%, which was very, very healthy. Now, we expect earnings growth to go 6% in my base case, which is not the extreme case of tariffs. It assumes that the 20% extra on China sticks, and the reciprocal tariffs, because we don't know the level of details right now, we assume that there's an across-the-board trade-weighted increase of 5% for the rest of the world, right? Which is reasonably conservative, but it can be worse than that, not better than that, most likely, right? Under that scenario, my earnings forecast is essentially cut by almost 50%. I have a bear case in which S&P goes to 4,400. In that case, I have earnings going down about 2.5%, right? Which means a swing of almost 15 percentage points from where we were earlier. So the magnitude of these changes is big. The second is, what multiples are you willing to pay on the market, right? And so, we take a sum of the parts approach for S&P, in good part recognizing the structural change in US equity markets over the last 15 years, which is essentially the primacy of the tech sector, which today in aggregate accounts for almost 40+% of S&P. And within that, big tech as a group of just 6 stocks, you don't include Tesla in it, itself accounts for 30% weight, 25% of S&P earnings, and more than 50% of S&P returns in the last 2 years, right? So to give you a sense, that particular group of stock, which is very critical and has been the fulcrum of this market, their multiple was 31 times at the beginning of the year. Last summer, it was 34 times. So we already derated. Now we're sitting at closer to 24 times. That's a 21% derating in big tech stocks, which is driving the market. And that's why, interestingly, as much as everybody talks about the sort of sell-off which has happened, one, it has been very orderly. The realized S&P volatility, as the market is sold off, is extremely low. So there is no panic out there. So the sell-off was also in broadly has been more concentrated in tech, especially big tech, with a 21% de-rating, which is basically telling you that the market is highly uncertain about the growth prospects of the US economy. On top of that, big tech has its own issues where in the last 6 months, there's been an intense scrutiny on the intensity of capital spending and trying to find out when will they start monetizing it to be able to justify those hundreds of billions of dollars of capex. And that's why, I think we were talking earlier before the show, we are still positive on big tech. We've been positive since the fourth quarter.
And so it's a valuation call on big tech, and obviously you must project solid earnings growth?
Yeah. So the consensus earnings growth for big tech is around 16% for this year, which is extremely strong compared to the rest of S&P. We think actually the number will be closer to 20-21%. If you look at the last 6 quarters, they've been beating their earnings number by anywhere from, call it 8.5 to 14 percentage points, right? So we do expect that to moderate, but they moderate it to still very healthy levels. But what we do recognize is in this environment of macro uncertainty, an environment in which there's more scrutiny on the capital spending and their ability to monetize it. And also where on an idiosyncratic basis, for those individual big names, there are concerns cropping up. For example, when you look at Amazon, people are saying, what is the scale of competition AWS faces from Anthropic? Or as hyperscalers as a group, are they properly depreciating their server useful life at a time when chip technology is changing so fast, right? So there are some questions cropping up. So all that tells me is that these companies will have to deliver, and the macro uncertainty has to moderate, and they'll start working. But as the de-rating goes on, they actually become safe havens, because if things really start going wrong, remember this is one subgroup of stocks where the quality of earnings is extremely high, right? And even now as a group, their free cash flow yield is close to 3.5%, right? And the multiples have come down 21%. So where do you want to hide if things go wrong in that bear case scenario of let's say S&P earnings going down even further? I mean, we cut our numbers for S&P from 271 earlier to 262. Consensus is still closer to 271. I think they're going to come down.
Venu, it's always great to see you, especially here on set. Thanks for joining us.
Thank you.
First come the tariffs, and now bailouts from President Trump are starting to materialize. For more, we're going to welcome in here Yahoo Finance's senior columnist, Rick Newman. Rick.
What's up, Josh? So we know from the Trump Trade War 1 that took place in 2018 and 2019, our trade partners have already begun to retaliate against American exports, and we're going to get more retaliation, and that's going to focus heavily on agricultural products. So the playbook from 2018 and 2019 during Trump's first term was bailouts for farmers to compensate for all the business they lost in lost sales to countries such as China, Canada, and Mexico. Back in 2018 and 2019, aid to farmers amounted to $23 billion. And Trump's agriculture secretary is now basically saying, yes, we're ready to do that again. So farmers don't want bailouts. Over and over, they will say, look, we want open markets, not bailouts. But they're going to get hit by retaliatory measures with regard to Trump's tariffs. And bailouts are coming all over again.
What about, hi Rick, this is Al Root. Rolling bailouts to some of the larger exporters, a Boeing, a Deere, a Caterpillar. I mean, do you think that, farmers in the heartland, that's an easy sell? As other companies start to see real impacts, do you think there's a chance of any relief or any form of direct support?
Yeah, there certainly is a form of relief, but this is two different buckets. So the reason Trump can basically offer farmers cash is because he can tap what's basically a lending arm at the Agriculture Department, and that does not require congressional approval. Not so easy for industrial tariffs, as there's not a similar lending arm at the Commerce Department, let's say. But the way that Trump is going to offer reprieve on a case-by-case basis is through exemptions. We saw this the first time around also. So Trump, there were more than 100,000 exemption requests in 2018 and 2019. So a company goes to the Commerce Department and says, this particular tariff is killing us. Can we get a reprieve? And then the trade partner can do something similar on their end. I mean, this is all the behind the scenes activities that take place. And my guess is that one of the reasons Trump says he loves tariffs so much is because he gets to decide the winners and losers. I mean, literally on a product by product basis or even a company by company basis. So any companies that are going to get a break from Trump, they're not going to get a bailout check from the Agriculture Department, but they're going to get favorable treatment from from other parts of the Trump administration when they ask for tariff exemptions.
Great point.
Rick, always great to see you. Thank you.
Hi, guys.
Coming up, what's next for Intel? New CEO Lipton making his first public appearance at the Intel Vision Conference on Monday. We're going to check in with an analyst on the other side, discuss the future of that chip giant. Stick around. Much more market domination still to come. Intel CEO Lipton making his first public appearance at the Intel Vision Conference yesterday. Tan, who remember took over as CEO on March 18th, saying the chip maker is spinning off assets that aren't central to its mission. For more, now going to bring in Patrick Moorhead, founder, CEO, and chief analyst at More Insights and Strategy. Patrick, always great to see you. So Intel has its big conference. Lipton is there, Patrick. You're at the conference. You spoke to the man himself. What did he have to tell you, Patrick?
Yeah, so he's in here, it's 14 days in, right? And everybody's expecting, okay, he's going to bring the tablets from down on high, and we're going to talk about all the changes. And, you know, we really got none of that. We got a lot about him, why he took the job, his background, some of his core fundamental beliefs. But if I were to boil it down, it was about, we're going to focus on the customer. This is what we want to do. Every tech company says this, so nothing new there. But I think it was a good carry-on from when the co-CEOs were announced. Naturally, he's going to be talking about innovation and how to do that. Some things that I think would be investors would be super interested in would be cleaning up the balance sheet and simplification and efficiency. So that was really I would say the depth of the conversation, the question and answer session that we had there. There was a lot of talk about, some big announcements, right? 18A going into risk production, lots of talk about custom CPUs, not a lot of public talk about GPUs in the data center though, which I found a little surprising.
Patrick, this is Al Root. It's so early in his tenure. It's tough to call. Did he win the press conference or not yet? Maybe what are 2 or 3 things you'd like to see Intel do or him do to sort of like get this ship turned in the right direction? GPUs, foundries, whatever it is. What should we look for as those 2 or 3 bullet points?
Yeah, so Al, I've talked to the senior executives at Intel's largest customers, and they want to know what the game plan is, right? He's met with them. They've talked about what they want, but they just want decisions. They want decisions on what businesses are you going to stay in? Which ones are you going to exit? How are you going to get more efficient without potentially adversely impacting the product roadmap? Because every change in Intel means that their customers have to flex. But at a macro base, I would say from an investor point of view, investors should care about what their customers want, but also how are you going to clean up the balance sheet? Are you committed to going toe-to-toe with TSMC? Because it's one thing to say, I want to be a foundry and I want to be a foundry for my own Intel designs. It's a very different matter to say you're going to go head-to-head with TSMC. We've heard a lot of things early on that suggest that Lipton wants to stay in the foundry business. But certainly, if you wanted to spin it off, he's not going to say something adverse to that effect. And he wants to maximize value for whether he keeps it or if he sells it.
What about also, Patrick, this emphasis, as I was reading, on new products, including custom semiconductors? What did you make of that? Smart move, in your opinion?
Yeah, I think custom CPUs are a super smart move. Quite frankly, they should have done it 5 years ago. You have all the hyperscalers, most of the hyperscalers rolling their own ARM-based custom CPUs. In my discussions with the hyperscalers, they are very interested in a custom x86 processor for a couple of reasons. First of all, they can run, the belief is that they can run highly efficient workloads, new workloads, modern workloads, but they can also run, I would say, more legacy workloads, or those workloads that enterprises are putting into hyperscalers like VMware, like Oracle, anything that's on premises.
You know, I feel like I have to ask, you brought up TSMC. It's Liberation Day tomorrow. We have hundreds of billions of dollars being spent by the chip giant. What is sort of the political backdrop in terms of impacting capital spending, and then maybe some of those key decisions that Louboutin has to make over the next 6 to 9 months?
Yeah, so the good thing is that the hyperscalers have committed to doing their $350 billion in CapEx. So that's a good thing, and they're not wavering at this point. Now, that could be affected if tariffs hit big in Taiwan. And again, it's not a one-for-one between transfer cost and the price that, let's say, NVIDIA charges, but there will be a mark somewhere, because I don't think the hyperscalers will pull back. I think they will have to pay just a higher price for that silicon, which could be adversely impacted to how investors view an increased CapEx, right? If you didn't think the 300 to 350 billion was big enough or impressive, put on an extra 10% onto that and see what happens. But first and foremost, it's uncertainty. And I think that's the environment we're at, where people just don't know what to do. They can put in their puts and takes and make trades that put them into a lower risk position. But the game seems to change about every 24 to 48 hours. So it's tough.
Patrick, I want your views on another headline I saw today. This was Bloomberg out with a report, citing sources, Patrick, talking about how Commerce Secretary Howard Lutnick signaling he could withhold promised CHIPS Act grants as he pushes companies to expand their U.S. projects. So it sounds like, Patrick, Lutnick basically is saying, listen, I want you to do what TSMC just did, which is announced they're going to invest another $100 billion. I'm just curious, Patrick, what do you make of that headline?
Well, the devil's in the details, I like to say. First off, let's get some facts out there. A CHIPS Act is not just a giveaway. There are very set milestones of what these companies have to do before they get the money. You might be thinking, well, wait a second. CHIPS Act was formed. They started writing checks. Only very small parts of that entire CHIPS Act funding has been spent. I don't think this will impact companies like Intel and TSMC, and maybe not even Micron, but we'll see what it could mean to Samsung. Intel already made its $100 billion commitment. It made it earlier. It didn't do it on stage with President Trump, but they did this already. Samsung made a very substantial commitment in Austin, Texas, as did Micron in New York. I feel like this is the politicization of the CHIPS Act as it's looked at as a tax. History shows that every type of funding or helping that's gone into semiconductors, there's about a 4-to-1 or 5-to-1 increase in tax revenues that come out of that, because all of these companies have to come in and support these foundries, not just to build it, but over 10 years to maintain it, to bring the energy in, to bring the supplies, the gases, to make this happen.
Patrick, always great to see you, my friend. Thanks for joining us.
Thank you.
All right, let's get to today's trending tickers. Hims and Hers announcing it's going to offer Eli Lilly's GLP-1 drugs after already offering Novo Nordisk weight loss drugs. Yahoo Finance's Anjali Kamlani is here with the details. Anj.
That's right, Josh. Well, we know that, of course, Hims is one of those platforms, telehealth platforms, that offers for a cash price some of these GLP-1 drugs. They have already been offering Novo Nordisk semaglutide, the compounded version, as well as the branded versions, and now is opening the door for Eli Lilly's products. That includes the older GLP-1s, the liraglutide and the generic version of that, so not the branded Saxenda and Victoza, as well as the blockbuster ones, of course, Mounjaro and Zepbound. And that is for a sticker price of $1,800 or almost $1,900 a month. And that is because they have the cash pay population. So that's good news. This adds to the partnerships that Eli Lilly has been increasing with telehealth platforms to sort of contribute to access to these GLP-1 drugs. Already they have through Lilly Direct names like Form Health, 9am Health, and KnownWell. They also had a partnership with Ro that they announced, which is sort of a competitor for Hims. So this really tells you the story of how they're opening up the doors for that competition.
Switching gears, Anj. Johnson & Johnson facing a setback with its talc litigation. What happens next there?
Yeah, so we found out, of course, earlier that the judge tossed out this bankruptcy case, and the question was then, what is Johnson & Johnson going to do? So we heard from their executives earlier today talking about how they're going to go back to the multi-district litigation. They had already had several cases through that avenue, and according to them, won 16 of 17 in that way. So that they're looking that as maybe more favorable for them to kind of settle the rest of the cases. They do not see a path to continue through bankruptcy, and they're also expecting many of the cases that came through the bankruptcy build out to be ineligible for this MDL pathway. So that's why they're looking at it as potentially helping to reduce the burden. We have seen the stock, of course, down on the news because Wall Street's not really liking this continued uncertainty for the litigation overhang that you see there, down more than 7%, and that's been growing since earlier today. We also know that of the 75% buy-in that they needed for the bankruptcy, they got over that threshold, 83%, and the judge questioned how they got to that point and throwing out that. Important to note that even though Wall Street doesn't like it, the total $8 billion that they had set aside in the reserves was only 2% of the company's market value. So like you're talking about a company that has $20 billion cash flow over last year. We heard from J&J CFO Joe Woke, who we know has been a friend to the show, saying that right now we're accruing a reserve for those amounts, but we anticipate they will be nowhere in the range of where we were otherwise proffering to settle this case. This is referring to the multi-district litigation. And in order to obtain finality in the near term through the bankruptcy proceeding, that was their goal. Now they're saying that they do still anticipate a near-term resolution, maybe not as quickly, but they also need to wait for the number of cases to kind of fall off. So that's where things stand right now.
We'll keep watching. Thank you, Anj. Appreciate it. Well, let's check in on Newsmax, because that stock ripping, extending its massive 735% gain following yesterday's IPO. Al, maybe viewers right now having kind of meme stock recollections and moments. It's kind of got it feels like these moves are incredible. By the way, Bloomberg is out with a piece just talking about, all right, this spike we're seeing here, they note, has made some folks very rich, at least on paper, Al. They point out founder and CEO, that would be your man, Christopher Ruddy. So he owns nearly 1/3 of the company's shares. That would be worth, Al, a cool $8.4 billion, that's with a B. Interactive Brokers Group founder, Thomas Petterfy, owns the second largest stake. Also looking pretty good here, now worth nearly $5 billion.
Well, you're depressing me because if you look at News Corp and Fox Corp, it's not the same level, unfortunately. Meme stock is right. Mm-hmm. Listen, so if you're asking the Barron's associate editor and analyst,
yes,
you must not chase these moves. If you are desperate, you take a very small portion of your portfolio just so you can say you were there, but you have to wait for these things to settle down.
Wise Barron's advice is always out. Thank you. Coming up, gold setting a new high for the fourth day in a row. We're going to discuss what's ahead for the precious metal with a strategist that's right on the other side. Stick around. Much more market domination still to come. Gold is taking a breather after setting a new high for the fourth day in a row. Concerns over the economic impact of President Trump's tariffs driving the lift in demand for safe haven assets. Here with more on what is ahead for the precious metal, we got Blue Line Futures Chief Market Strategist Phil Streible. Phil, it is always great to see you and to talk gold, Phil. And I had a question, and I think you're just the man to ask this, Phil, is that, listen, gold has been glittering. Folks have been diving in there. It's been risk off. What if tomorrow, Phil, and obviously we've had this date now on our calendars, Phil, April 2nd, right? We've all been waiting for this. It's Trump, it's Liberation Day, it's the new tariff plan. What if he comes out tomorrow, Phil, about 24 hours from now, and who knows, Phil, maybe he actually sounds relatively more friendly, maybe more accommodative than people are expecting? What would that mean for the gold trade?
I've been thinking about that, and that's, I think, on the back of the minds of many gold investors. I mean, April 2nd, this is like the Super Bowl of tariffs, and how much fear is priced in the market. This is like a market-moving event. This reminds me of like when CPI was coming out or the jobs report. But the reality is that gold does have everything going for it right now. Yes, you have this event risk, you got the U.S. trade policy, but fiscal policy, monetary policy, now they're factoring 2 to 3 interest rate cuts in 2025. You got geopolitical situation. It's volatile in the Middle East, Russia, Ukraine, China, Taiwan. You've also got a global growth slowdown with a 30 to 40% chance of a recession. So the precious metal has been one of the strongest performing commodities this year, posting its best quarter since 1986. And multiple financial institutions are increasing their price targets since we passed through 3,000. Now it's 3,500 and beyond. So as long as you've got the strong central bank buying and the demand there, particularly from the emerging markets, and the solid inflows into the exchange traded funds, I think gold has some backing and some support levels. Now, tomorrow's event, the average true range on gold, it's moving about $40 a day. You could see 2 times that. So something like $80, I wouldn't even bat an eyelash if this thing sold off that much just to come back here and charge on to new all-time highs.
Phil, Al Root, you build a strong case, I'm sold, but do I want miners? Do I want the metal? What's the best way to do it from here?
You've seen that movie Gold Rush and what a disaster that is on a day-to-day basis. Why would you want to own a miner like that when you're just trying to speculate on the underlying price of the metal? Miners, we've seen record gold prices and we've seen them, yes, post record profits, but the revenues just aren't there. Their big impacts are rising labor costs, rising inflation costs, gasoline, insurance, labor, everything else. It just doesn't make sense, in my opinion, to own these miners. And I think that there's a lot more risk owning them. You got to know what metal they're producing and where they're producing it at. So it's just, in my opinion, it's just not the way to play it. You got to play the pure price play. I think you go with the futures contract or minimum one of the ETFs in order to be in for that ride.
So bottom line, Phil, when you're looking at a chart of the metal here, what levels specifically are you watching?
Okay, now the technical, that is the one scary part of it, because that's the only thing I don't like about the price right now, because the cure for high prices is high prices. Technically, it's overbought. It's at the top end of a trend line. It had a shooting star pattern set up here today. Oftentimes appears to be the top end of the market. I think if you're smart, I think you wait for a pullback in this market. Oftentimes, just like you were talking about Newsmax, the pullback always occurs when you least expect it, and that's when prices really come down. So yes, to the original statement in this, if Trump does come back with a little bit more relaxed tariff strategy and talk and seems to be a little bit more open-minded, I think you see some of the exit coming out of the gold market, out of the safety, reducing some of those hedges, and then you're going to see people go back into U.S. equities because of the fact that they've sold off so greatly. I think that there's a lot of great opportunities and a lot of good companies there.
Is there any other opportunity? Will we be looking at any other precious metals, silver, or any other industrial metals over the next few months?
Okay, so you look at the problem with silver right now is that it failed at a double and triple top at $35. The gold-silver ratio is 90-1. That shows you that it has outperformed its peers. Silver is 54% industrial demand. So you need to really put on your thinking cap if you're going to watch the silver market and speculate on it. You've got to see industrial strength. You need to see growth. You need to see China really come back and come back strong. The copper market, that's one that took a playbook out of steel and aluminum where It rallied into the announcement of the tariffs, and once the tariffs were announced, it pulled back from here. I do believe that long-term structurally copper is one of the best metals to be in because of the construction, the rebuilding efforts that are going to go on with so many natural disasters and repairing, parts of Ukraine and things like that. The copper demand is there, and a supply is very difficult to bring on right now. So copper may be pulling back, but I think there's a new price band to play, maybe 450 to 550 rather than the, we're stretched too high and it really should be back in the threes.
Phil, always great to see you. Always great to have you on the show. Thank you.
Yeah, thanks for having me.
And while we are wrapping today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.